I like this post a lot on r/stocks. It's titled, "Is anyone actually bullish right now?" And he's not asking day traders, he's talking about the average Joe. And news articles like this, where people predict a market bottom or recession in 2023, is what that post is largely referencing. Stocks are facing rough times between now and first part of 2023 as the Federal Reserve rate hikes and weakening consumer spending squeeze corporate profits. Markets will likely bottom sometime in the first half of next year. The S&P 500 could sink to levels between 3,500 to 3,750 and potentially as low as 3,000. And here's a little visual graph on what that really looks like. Historically, earnings fall by 15 to 20% when the US enters a recession. And then again, they reference inflation and tightening financial policy. So yeah, that's the situation. I hate to go along with the masses, but it does seem like, at least for the next 1.5 years, the market is going to be rather rough. And if we come back to this original post on Reddit, it has almost 900 comments, and we can use this to gather general sentiment of the US stock market according to regular investors. So this guy says, the US is probably fine for now, but the European energy crisis will probably drag us into some sort of recession as winter hits. And that's a pretty logical statement. The main worry for me is that we experience a period like 1966 to 1982, sideways trading and no growth for 16 years. And this comment has over 1,000 upvotes right now. So it goes to show that people aren't necessarily super afraid of a massive, sharp correction like we had back in March 2020, but rather a stagnant growth trajectory for a prolonged period of time. Now, if you guys watch the channel, you know that my solution for this is dividend/income investing, along with some covered calls to boost yield. And if we take a look at some of the responses to that comment, we do see a lot of people offering the same advice. This comment says, go into dividend aristocrats. They outperform the S&P 500 during recessions and sideways markets. And I actually have the data on that right here. And he's correct. This data shows that dividend growers and initiators in particular have the best returns with lowest volatility levels. And this piece of data is on the various bear markets and recessions throughout history. It shows the peak S&P 500 decline and the dividend change in the S&P 500. And we can see the greater level of stability found in dividends. And we should all be familiar with this graph, which shows the S&P 500 return split between price and the dividends. And we even have comments saying this is a great time to sell covered calls if you think the market's going to be flat for a while, with quite a few ups. Okay, so that's the general consensus on the short-term state of the US economy and what you could potentially do about it. But keep in mind that people are usually wrong when trying to predict the future. So I think the best thing I can do right now is to bring it back to the basics. I want to do some Eco 101 on inflation with you guys right now. Then we're going to take a look at some related data that could affect the model, and then give you guys, my final prediction. So we currently have inflation for two broad reasons. The first, and I would say most major one, is all the COVID-related stuff that's been happening over the past 2 years. The two big subcategories are lockdowns. This affects the supply chain, so the supply side of economics. And the second subgroup is the economic aid many governments gave out, and this affects the demand side. Now, this is a very simplistic breakdown of the situation. In reality, this is a global thing spanning over 2 years. There's been multiple waves. China is still locking down. But just to keep it simple, these are the primary drivers in the COVID category. And the second main cause here is the war in Ukraine. And the major effect this has on inflation is on top of the COVID lockdowns affecting supply, but the increase in commodity prices, namely oil, natural gas, and food like wheat. So let's go ahead and put this on a chart. And for any of you guys that have taken Econ 101, this should look extremely familiar. So the x-axis is price, and the y is quantity. In blue, I'll put the demand line. D stands for demand. And in green, this is the supply. So the way you can read this is as the price of any given good increases, the supply of it on the market will also increase, but the demand will decrease as that becomes more and more expensive. Now let's apply the current causes of inflation to this graph. So as we saw, we have lots of supply chain bottlenecks. So that causes the supply line to shift downward to something like this, and we can call this S1. So this is the new level of supply of any given good in the economy. And due to the economic aid and the accommodative monetary policy, the consumer demand for lots of goods have increased. So that causes the demand line to shift to the right in a new location like this. We can call it D1. So ultimately what this does is the equilibrium goes from being over here to over here. And if we draw a dotted line straight down, everything is now more expensive. And this is the basic explanation of the level of inflation we're currently seeing in the economy. So with this all visualized, hopefully this gives you a bit better perspective on the solutions to the problem. The Fed is trying to retighten monetary policy. So in the next meeting in 2 days, there's currently an 82% consensus that's going to be a 75 BP rate hike. And again, the point of that is to bring the demand back closer to where it was. And I want to point out here that nothing in economics is an exact science. There's no interest rate that has a corresponding level of consumer demand. Lots of this is based off of human behavior and expectations. And I know everybody hates the Fed and their strategy right now, but it does seem to be slowly working. So this is the Consumer Confidence Index, and this is an indicator that provides indication of the future development of households' consumption and savings. And if we take a look at the chart right here, recently it has been taking a nosedive, and this goes all the way back to 1975. And this is both good and bad. So in terms of the economy, it does indicate a recession, but a recession and spending less money, so having demand come down, is the remedy to inflation. Also, we have things like this. US consumers' long-term inflation expectations dipped to the lowest level since mid-2021. The price expectations for next 5 to 10 years edges down to 2.8%. And on the supply side, there's already some indications that it's beginning to recover and catch back up to demand. So to sum this all up, I know there's a lot of data and it kind of seemed all over the place, but this is kind of my take on the situation. So it does indeed seem like, at least in the short term, we are heading into a recession if we're not already in a recession. The Federal Reserve is aggressively retightening their monetary policy to get a grip on things, and it seems like in their next meeting, there's an 82% chance of yet another 75 basis point rate increase. Based off of the Consumer Confidence Index, it does seem like this is having the intended effect, bringing down demand, and this might also be contributing to the long-term inflation expectations being rather mild. And eventually, once there's solid data that inflation is coming down, the Fed will pivot towards supporting the economy again to bring it out of this man-made recession. And that might happen sooner than most people expect, and if that does indeed happen, it'll be a huge boost to stock prices. Because again, the Fed has a dual mandate: price stability, which they're currently tackling, all cylinders firing, and the second is employment. So that means maintaining a good economy. So once inflation comes down, they will support the economy, at least in my view. But let us know in the comments down below what you think. If you're still watching and enjoyed, like, subscribe, and I'll see you guys next time.